The deep dive is on. Today, we're going to dissect what I think is one of those stunning corporate near misses in recent memory.
It really was.
The December 2025 IndiGo crisis.
Huh?
Now, if you followed the news, you saw the public story. A major airline just canceling over 1,000 flights.
Yeah.
In a single day.
Yeah.
And the headline was all about operational failure, pilot shortages. The scheduling was chaos.
And the new FDTL rules.
And those new FDTL, the flight duty time limitations, regulations kicking in.
And look, that operational failure was absolutely real, no question. But here's the core insight of this deep dive. The chaos you saw at the gates, the refunds, all this canceled holidays, that was just the operational mask.
Right.
Underneath this was a severe, and I mean severe, Treasury failure. Our mission today is to pull that mask back and show you the hidden financial story, because that story, you know, it determines whether a shock is just a potholer.
Or an existential cliff.
Yeah.
And it feels like a classic case of multiplicative risk, doesn't it?
Mm-hmm.
When the operational trigger hit, it didn't just cause refunds. It exposed this critical fragility in the financial foundations.
Exactly. It's not a single point of failure. It was the lethal combination of three factors hitting all at once. You had almost non-existent liquidity buffers, zero meaningful FX risk management, and a complete reliance on, well, manual, outdated systems. When that operational pressure arrived, those financial gaps just amplified the risk exponentially. It was a crisis of structure, not just scheduling.
Okay, let's unpack this. And to start, let's use a simple analogy to make these pretty dense topics relatable for you. We call this the Riya's piggy bank analogy.
I like this one.
It really illustrates the fundamental financial mismatch IndiGo is facing. So imagine Riya is IndiGo. She earns her money in Indian rupees. They'll say it's her weekly pocket money, 100 rupees.
That's IndiGo's ticket sales.
Exactly. But Riya has this dream. She wants to buy a sophisticated robot toy, but it's priced in US dollars, $10. And IndiGo faces this exact structure. Over 85% of its revenue is in rupees, but it has these massive, non-negotiable contractual obligations.
Aircraft leases, fuel bills, maintenance.
All priced in dollars.
And just to put a number on that, IndiGo had approximately 4,100 crores, that's over $500 million US dollars, in monthly USD obligations. They had to be met, you know, regardless of what the rupee was doing. That's the definition of a significant currency mismatch.
So now Riya faces the first shock, currency depreciation. The rupee weakens, say, from 82 to 86 per dollar. Her $10 toy instantly costs 40 rupees more. It goes from 820 to 860. It just takes her longer to afford it. That's the foreign exchange risk in action.
But the real pain, the real killer, comes with the second shock, the operational one. The new flight duty time limitation rules, the FDTL rules, they dictated how much rest pilots must get. That's a regulatory mandate.
Right, you have to follow it.
You have to. And that, combined with some poor internal planning, triggered mass cancellations. So for Riya, it's like her parents traveled less, so her pocket money, her collections, it just dropped by 80%.
And for IndiGo?
Their daily cash inflows, normally around 450 crores, plummeted to a fraction of that. Some sources suggest collections dropped to only 50 to 100 crores daily at the peak of the chaos.
And that jewel shock collections collapsing while the cost of dollars shoots up at the same time, that is what turns a standard operational problem into a full-blown financial crisis.
And this is the asymmetry you have to see. Riya can wait to buy her toy. IndiGo cannot wait.
No.
Those aircraft lease payments, those fixed USD obligations, they are due in full on schedule.
Okay, so that brings us to the technical terms that define this fragility.
Right. First, the massive FX exposure. IndiGo had a net INR mismatch of over 3,000 crores. So what does that mean in, like, practical terms for the CFO?
It means every little move.
It means every single percentage point the rupee depreciates against the dollar adds tens of crores of unanticipated costs to their balance sheet instantly. It just erodes capital.
And the second piece, the liquidity buffer. How much rainy day cash did they actually have?
Far, far too little. I mean, we define the liquidity buffer as the emergency cash runway. It's the number of days a company can pay its fixed bills without bringing in any new money.
And IndiGo entered the crisis with?
Only an 18 to 20-day cash runway.
Wow.
To put that in perspective for you, major resilient airlines, you know, Lufthansa, Singapore Airlines, they target 90 to 130 days. IndiGo's treasury was running on fumes even before the chaos started.
Okay, so let's move past the trigger. Let's talk about the treasury domino effect.
Yeah.
The FDTL rules were the spark, but the financial structure was the tinderbox.
Absolutely. When collections collapsed by nearly 90%, the fixed outflows, leases, payroll, they stayed constant. So the cash burn just started accelerating at a rate the company was structurally unprepared to handle.
This is where that decision not to hedge becomes financially devastating.
Yeah.
I mean, we're talking about massive numbers, 4,100 crores in monthly USD expenses, with only 5 to 10% hedging coverage. I have to ask, why did a major corporation ignore such a basic principle of financial risk management?
It was a strategic choice, and it was rooted in what you'd call an efficiency-optimized mindset. Hedging costs money, right?
Sure.
You buy currency insurance, it's called a forward contract, and that costs about, say, 0.5% to 1% of the amount you're insuring. And when the rupee is stable or even appreciating, that money just looks like a drag on your quarterly profits. Management sees it as an unnecessary expense.
But let's look at the math of that complacency.
Let's do it. If the rupee moves just 2 points, say from 84 to 86 per dollar on that gigantic unhedged portion of 4,100 crores, you are looking at an unexpected, unbudgeted cost increase of over 100 crore in a single month.
And that 1 month cost is way more than the entire annual cost of insuring against it. Let's really drill into that ROI number because it is the financial climax of this story.
It's incredible.
If IndiGo had hedged even 50% of its exposure, which is still pretty conservative,
Very conservative.
that insurance would have cost them only about 14.35 crores annually.
Precisely. So that small investment in prevention protects against potential losses that could easily exceed 1,200 crores annually in a major depreciation scenario. So when you calculate the net benefit, the savings minus the cost of the hedge, you end up with an ROI of over 8,200%.
8,200%.
That's not a business decision, it's a no-brainer. This single data point shows that the decision not to hedge wasn't efficient. It was financially irresponsible when you factor in volatility.
And this neglect, it manifested very quickly as an insolvency risk. Our model showed that with that combined collection loss and the massive unhedged FX shock, the 18-day cash runway was just destroyed.
It was. It would be effectively depleted in 8 to 10 days, forcing the company into a projected 834 crore deficit by day 8 if that burn rate continued.
And the market saw it.
The market reacted immediately. This rapid erosion of cash is why Moody's issued that credit negative assessment. That signal wasn't just a slap on the wrist. It told the global financial community that IndiGo was managing a countdown clock to technical insolvency. They were just days away from being unable to meet their mandatory dollar payments, like leases.
Okay, if that's the reality, if the cash clock is ticking down that fast, we have to ask, how does the decision-making change? Let's pivot and look at the alternative. Let's contrast the internal vibe during the 9:05 a.m. briefing in IndiGo's headquarters with, I don't know, a peer like Lufthansa.
The qualitative difference is it's profound. In Gurgaon, the CFO's 9:05 a.m. briefing was existential. They're asking, how far do we cut costs? Which essential vendors do we defer payment on? Do we have enough cash to survive this if collections don't rebound in the next 72 hours?
Their decision-making is purely reactive. Messy.
It's totally reactive, focused entirely on short-term survival. The credit team is scrambling to secure an emergency credit line before the market hears the full extent of the cash crunch.
Now, contrast that with the resilient profile. Let's use Lufthansa. Their 9:05 a.m. briefing, even if they had a similar operational shock, isn't about survival. It's strategic.
Exactly.
They aren't asking if they have cash. They know they have 90 to 130 days of fixed expenses covered. They're asking,
are our hedge ratios still optimal given the emerging market volatility? Should we accelerate our fuel procurement? They are managing risk, not managing a panic.
And that strategic difference, it flows directly from their infrastructure, doesn't it? The Layer 5 systems gap.
100%. IndiGo's crisis was fundamentally a Treasury systems failure. They lacked a real-time FX dashboard. Think about that. They were making billion-dollar decisions based on stale, often end-of-day spreadsheet data. There was no formalized rolling hedge program.
And critically, no automated stress testing. No one ran the scenario. What if FDTL rules drop our revenue by 70% while the rupee spikes?
It was a failure of imagination combined with a failure of tool usage. Meanwhile, global leaders are operating with sophisticated treasury management systems. You might have heard of them like SAP, S/4HANA Treasury, or Kyriba.
Right.
And these are not just accounting tools, they are proactive risk systems.
Can you elaborate on that? Because naming the software is one thing, but what does it actually do that makes such a difference?
Okay, they do three things that save lives. First, they provide instantaneous, reconciled visibility of global cash flow. No guessing.
Real-time data.
Second, they automate the payment waterfall. If cash is tight, the system automatically classifies vendors. Tier A, critical. Fuel, leases, payroll. They get paid first. Tier B, essential but negotiable. Tier C, deferrable. This removes chaos and preserves your credit reputation.
And third?
Third, and this is the most crucial part, they run quarterly stress tests that explicitly model combined shocks. Like 70% revenue loss for 6 months, PLOS, a 20% fuel spike. They've already seen the disaster scenario.
So the qualitative difference is just massive. Lufthansa's system prevents vendor stress because critical payments are always met, systematically. IndiGo's manual ad hoc system creates vendor panic.
Because no one knows who's getting paid. That breeds mistrust, and ultimately, it raises their cost of capital down the line. The systems ensure the crisis never becomes existential. The ops team deals with cancellations, while the finance team deals with hedging optimization, not survival.
Okay, so let's move to the solution side. The recommended resilience architecture 2.0. You can't transform an organization overnight, so this must be tiered. What are the absolute must-dos for immediate stabilization in the first 0 to 4 weeks?
4 crucial items. First, secure a committed emergency credit line. Let's say 1,000 crores within 2 weeks. This is the financial equivalent of oxygen. It extends the cash runway from 18 days to maybe 45 and immediately removes that solvency anxiety. It gives the team space to breathe.
Breathing room is everything in a crisis.
It is. Second, activate a conservative rolling hedging program. Start small, even 25% of the next 6 months USD exposure. Do it immediately via simple forward contracts. It locks in discipline, and it stops the immediate FX bleeding.
And what's the third priority?
Deploy a crisis dashboard MVP in 1 week. Forget a full system implementation for now. Get a minimum viable product dashboard running that tracks 3 things in real time: cash balances, collections rates, and the interbank FX rate. Gut feel decisions have to be replaced with visibility.
And finally, formalizing that payment waterfall you mentioned.
Yes, they must document a rigid payment waterfall, classify vendors, critical, essential, negotiable, deferrable, and then communicate this internally and externally. That structured approach reduces chaos, maintains critical relationships, and preserves future credit lines.
Okay, those are stabilization efforts. The long-term view over the next 18 months, that's where the foundational change happens.
That transformation involves 3 core pillars. First, full implementation of an integrated treasury management system to get that automation and control. Second, expanding the hedge coverage to a target of 50% of the forward USD exposure, making that 8,200% ROI payoff.
Right.
And third, establishing a formal minimum liquidity buffer policy. They should aim for cash sufficient to cover at least 30 days of fixed outflows, moving them closer to global standards.
So what does this all mean when we zoom out, bringing us back to that fundamental strategic choice layer 7?
The crisis forced IndiGo to choose between the efficiency-optimized model and the resilience-optimized model. Pre-crisis IndiGo was lean costs, thin buffers, minimal hedging. The result: fantastic operating margins in benign conditions.
Great when things are going well.
But fatal fragility: the moment regulation or markets shifted, they won the race until the rain started.
And the resilient profiles, the Lufthansa and Singapore Airlines, they operate on the resilience model.
Right. They incur slightly higher carrying costs. They pay for the buffers, they pay for the hedges, they invest heavily in the systems, but the payoff is survival. They may have lower peak margins, but they gain market share and strategic dominance while their competitors are forced into retreat. Resilience is the ultimate competitive advantage in volatile markets.
The essential learning here is just brutally clear. Operating an airline, or really any global business in a single currency environment, requires more than operational excellence. IndiGo had the operational chops, but survival in a combined shock depends entirely on the strength of your financial immune system.
And the cost differential is staggering. The estimated cost of not preparing, the loss in market value, the reputational damage, the disruption, is estimated between 10,700 and 16,300 crores. That colossal figure absolutely dwarfs the estimated cost of prevention, which was perhaps 200 to 250 crores for the full 18-month transformation.
That gulf between prevention and damage is why this crisis proved that Treasury is not back office plumbing. It is the resilience architecture that determines whether a shock is a pothole or a cliff.
And the question for you, the learner, is personal and immediate. If your industry faced a combined operational and FX shock tomorrow, what would your 9:05 a.m. briefing reveal?
Would you be managing a financial countdown clock, asking if you have enough cash to survive the week? Or would you be strategically reviewing whether your hedge ratios are optimal? The lesson is you pay for resilience eventually, either in small insurance payments now or in massive market damage later. We'll leave you with that thought. Thanks for tuning in.